As U.S. companies continue to expand abroad, they must understand how the U.S. may continue to tax their foreign activities on an annual basis. Welcome to Accounting with Audra. In this video, I'll discuss how Subpart F Income under Internal Revenue Code Section 951 is a significant tax provision that many global companies must navigate as part of their overall tax strategy. I'll start with a walk through the definition of Subpart F Income, and then discuss and provide examples of transactions that fall within the provision in this video. There are some exceptions to the Subpart F rules and additional mechanics to actually compute the U.S. deemed inclusion. In other words, what is subject to U.S. tax immediately. The exceptions and inclusion computation will be discussed in subsequent videos. Prior to 1962, U.S. multinationals were able to shift income earned on certain transactions to foreign jurisdictions with low or no tax. Imagine manufacturing a product like a bike in the U.S., selling it at no markup to a 0% tax country, adding some handlebars to the bike, and then selling the bike for its full profit to users outside the U.S. Since the income was earned outside the U.S., taxes from a U.S. perspective were permanently deferred until the income was repatriated, dividended back to the U.S. This helped companies achieve low worldwide effective tax rates on earnings. In 1962, Congress enacted a new set of provisions in Code Sections 951 through 954, aimed at disallowing certain income earned offshore from being deferred from U.S. taxation if the transfer of earnings out of the U.S. to the offshore jurisdiction was deemed abusive. As a result, sometimes transactions affected in the ordinary course of business fell within the Subpart F regime, resulting in unintended tax consequences. It's important to first understand which U.S. companies are subject to the Sub-F provisions. Sub-F provisions apply only to U.S. shareholders of controlled foreign corporations, CFCs. So foreign investors are not bound to these provisions, and understanding the organizational structure of your company is important in determining when these provisions may apply. Keep in mind that when determining CFC status, you look to the direct, indirect, and constructive ownership in a foreign corporation. Once you determine you have a CFC, annual tracking of that CFC's gross income is required because any income considered Subpart F is taxed in the U.S. as earned, whether or not it has been repatriated back to the U.S. Subpart F includes various types of income the U.S. deems to be included in the U.S. even if earned in a foreign jurisdiction. In other words, territoriality no longer matters from a U.S. perspective. Income items earned by a CFC may include those items easily shifted on paper or types of income the government would like to deter companies from engaging in, including certain insurance income, income from bribes, kickbacks, and illegal payments, international boycott income, and income from blacklisted countries regularly updated. Tracking these first four categories of income can be straightforward for companies. The difficulty really lies in understanding the fifth item of income, labeled foreign-based company income, as everyday business transactions, without meaning to, can fall within this category. Foreign-based company income consists of three different subcategories of income. They're known as foreign personal holding company income, foreign-based company sales income, and foreign-based company services income. We are going to walk through each type of income in this fifth category, the general rule, and then specific transaction. Foreign personal holding company income is better known as passive type activities within an organization. Revenue items included under the general rule are dividends, interest, royalties, rents, and annuities. Gains and losses arising out of certain property transactions, the net gain on these. The net gain from commodity type transactions. Foreign currency gains and losses from 988 transactions. And income that's equivalent to interest or from notional principal contracts and payments in lieu of dividends. Revenue earned in these different categories are tracked within their respective income classification. Subpart F income looks to gross income items, and any net losses in one category are not permitted to offset other categories of income. For example, if there is for the year a net loss from a commodity transaction, it cannot offset dividend income in the other category. No netting is permitted. The key is looking at certain transactions where a CFC is receiving income from other legal entities within an organization, but is doing little to generate the income. Congress is asking why, if the company is a U.S. headquartered company, are those types of income not just earned in the U.S.? There are some exceptions to foreign personal holding company income, whereby passive income with related parties may not be considered this type of income to ensure the intent of the regulations achieve what they were set out to achieve. Those exceptions include the same country exemption, active business, CFC look-through, and active financing exception. A detailed discussion of each of these exceptions will be provided in a separate video. The second type of foreign-based company income is known as foreign-based company sales income. This relates to income derived in connection with the purchase or sale of goods with a related party and an unrelated party, where the property which is purchased, sold on behalf of a related party, is manufactured, grown, or extracted outside the country under the laws of which the controlled corp is created or organized in. And the property is sold for use, consumption, or disposition outside such foreign country. Or, in the case of property purchased on behalf of a related person, is purchased for use, consumption, or disposition outside such foreign country. Revenue earned includes commissions, compensation, fees, or other income derived by the CFC in connection with this purchase or sale. In order to better understand instances where property may be bought or sold between related and unrelated parties to which Subpart F rules apply, we're going to walk through 3 examples. In example 1, a CFC purchases personal property from a related person and then sells it to any person outside its country of a corporation. Assume we have 2 shareholders. The U.S. shareholder owns 80% of Irish Co., and the other 20% is owned by a foreign investor. The Irish company is considered to be a CFC of the U.S. shareholder. The U.S. shareholder then sells product to Irish Co., a related party. If Irish Co. then on-sells the products to customers, and the customers are outside of Ireland, and let's say that shoes are being sold in Italy. Subpart F Income says the income earned by Irish Co. on the sale of the goods to Italy is foreign-based company sales income. Any sales made to customers in Ireland, on the other hand, would not be included in this income. They would not be Subpart F. In example 2, CFC is purchasing personal property from any person and selling it to a related person outside its country of incorporation. We can use the same fact pattern, but this time Irish Co. is purchasing product from unrelated vendors in Germany, which is not in Irish Co.'s country of incorporation. Irish Co. then sells the product to the U.S. shareholder. The income on this sale earned by Irish Co. will be considered foreign-based company sales income. In example 3, U.S. shareholder wholly owns a Swedish foreign corporation. In other words, Swedco is a CFEC. Swedco earns commission for each sale made by a U.S. shareholder to its foreign customers. The U.S. shareholder sells products outside the U.S. and Sweden to unrelated customers. In this example, Swedco is involved in the generation of these sales and is making a commission on these sales. In this scenario, the commission revenue, even though it's being paid by a U.S. company, is considered to be foreign-based company's income. In each scenario discussed, one side of the business transaction involved a related party, and one side of the transaction involved an unrelated party to the organization. All 3 scenarios are considered to have generated foreign-based company income that could potentially give rise to Subpart F income in the U.S. It should be noted that foreign-based company sales income also has an exception to the general rule known as the manufacturing exception. This exception is further discussed and illustrated in a subsequent video. The third type of foreign-based company income is known as foreign-based company services income. Generally applies to the performance of technical, managerial, engineering, architectural, scientific, skilled, industrial, commercial, or like services that are performed for or on behalf of any related person and are performed outside the country under the laws of which the controlled foreign corporation, or CFC, is created or organized. The revenue, in this case, can be in the form of compensation, commission, fees, or otherwise derived in connection with the services performed. Let's walk through an example to better illustrate how this differs from our prior scenarios. A U.S. shareholder owns 100% of a Polish corporation, which is a CFC. The Polish corporation is providing services to customers in the UK and Germany. These services are being provided on behalf of the U.S. shareholder. The services, for example, could have been associated with the product previously sold by the U.S. or part of a contract the U.S. was obligated to perform on. The U.S. shareholder contracted out this portion of the contract to the Polish corporation on its behalf. In this scenario, the revenue earned by the Polish corporation from the UK and German customers will be considered foreign-based company services income. It can be difficult to determine when services being performed by a CFC are for or on behalf of a related party. Section 1.954-4 in the regulations provide a variety of examples, all of which focus on the relationship between the CFC, the related party, and the customer. Who is providing the services and who is obligated? The regulation specifically notes certain transactions as being for or on behalf of a related party. Transactions include the CFC received substantial benefit from a related party for performing such services. In this instance, they're being compensated for services performed on behalf of that related party. The CFC performs services which a related person is or has been obligated to perform. In other words, the CFC is taking care of an obligation for the related person. The CFC performs services with respect to property sold by a related person, and performance of such services constitutes a condition or a material term of the sale. Finally, substantial assistance contributing to the performance of such services has been furnished by a related person or persons. This might be the CFC providing technical know-how that was necessary to complete the provision of the services. It's possible that on the face of a transaction, it appears a foreign corporation is performing services on a project outside its country of incorporation on its own accord. However, there's a need to understand whether any other related parties not within that CFC's country may be involved or have been involved in the project. Their involvement could trigger Subpart F implications for the CFC performing those services. To recap, our overview of Subpart F, a company doing business overseas must consider whether gross income from business transactions, passive in nature, discouraged by the U.S., or involving a related party, are Subpart F income. Then look to whether there is an exception to the base rule, and then finally determine what is included in the U.S. tax return at the end of the day. This video focused on how to identify those income streams that may give rise to that Subpart F gross income. Please subscribe to receive updates when new videos on the various exceptions to the general Subpart F rules and the overall Subpart F deemed inclusion computation are published. Please also stay tuned for videos on the new GILTI provisions and how Subpart F and GILTI impact one another.